We got to talk about regional bank stocks. They are looking to claw back some ground after Moody's cut its rating for 10 small and mid-sized U.S. banks on Tuesday and put 11 more on a negative outlook. Now, this comes as the KRE regional banking ETF has yet to recover from the failures that started during March. So are we headed back into a bank doom loop? Let's bring back in Ben Emons, who is the NewEdge Wealth Senior Portfolio Manager, head of fixed income and macro as well. So Ben, perhaps we start on that question and define for us what a doom loop would look like.
So it's a phrase coming from Europe, where the ECB has put this out actually amazingly. They said okay, the banks get into this loop between the sovereign and banks, meaning the banks hold a lot of sovereign debt. The value of that sovereign debt declines. That affects the stock price of the bank. The bank has to sell those sovereign bonds to make up for their capital requirement because of the lower equity value. As a result, sovereign bond prices fall even more, and that declines the bank stock price and so on. So that's your sort of loop idea. Now, if you take us to the United States, the regional banks are sitting close to $4 trillion of US Treasuries in their portfolios. This is including the major banks, but a vast amount of it sits in regional banks. We know that the value of the Treasury bonds has been declining, of late particularly. Moody's made a real specific note of it in their statement about that these unrealized losses in their portfolios continue to increase, which puts pressure on the bank's balance sheets and have to therefore raise reserves in order to offset those losses against other losses that they probably are facing on their commercial real estate portfolios. So there's a bit of this loop idea there too. If Treasury yields go up and the value of Treasuries declines, it pressures the stock price of regional banks, who then have to sell those Treasury bonds to make up for those losses and also build up reserves, and that can further affect their stock price. You look at the Fed data every week, which is this H8 or H4 data. It sounds like R2D2. H8 data, it shows every week the Treasury security holdings decline. That's not just the Federal Reserve, that's also commercial banks. And that note, I took note of that, thought the banks are really looking to try to change their composition of the balance sheet, but it is that loop idea. This is why the KRE ETF, to finish with that, has not really recovered from the March lows, right? It's still down about 15% year to date. It's trying to break out a bit, but it's really struggling. I think that's caused by this loop idea.
But sort of quantify all this for us. Like how doom loop makes it sound pretty bad.
Yeah.
But, yes, we had Silicon Valley Bank, which had some particularities on its balance sheet and that caused it to go under, but presumably these other banks are still in better shape, even if they're having to undergo this process. And I also have to wonder on the flip side, how high yields are going to get. Like how much further could we see, could this cycle sort of go on?
Yeah, I think, Julie, that's a good point, because the rise in rates that we've had over the last period, you could attribute it to that, the economy's been resilient and surprised and all that sort of positive dynamic, and markets reacting to what AI could do to productivity, and the other day productivity data was really strong and it drove up rates even more. So that's the macro side of it. But the micro side is that specific idea of that the banks are having a credit issue. There is an underlying deterioration of credit, and as a result, they have to, quote unquote, delever their balance sheet, meaning probably take out of their portfolios of treasuries more out of that, sell more bonds out of that in order to make up losses.
I get what you're saying, but then, what's the conclusion? What is it? Just that their stock prices remain depressed for a while? Do more banks go under? What ends up happening as a result of all this?
I think the first one first, that you have stock prices that are not really recovering, just like what happened with the big investment banks post-financial crisis, in some sort of an L shape. Citigroup is actually a really good example of that. Never really recovered. I think for some of these regional banks, that's the same. Second is that there's likely going to be more of these shotgun mergers potentially happening. PacWest is that example. You could see more of that. And thirdly, which by the way is dilutive for equity holders potentially, right, if you get these type of mergers. And thirdly, it's about that the credit crunch will continue. It will continue to slowly burn under the economy because banks have to pull back as a result of their imbalance on their balance sheet, so to speak, right? Interest rate risk is too high, they have to bring it down. And I think that slow burn credit crunch under the economy, eventually it comes to surface and does really slow down the economy. Don't think it will happen this year, but there's a possibility for next year.
So if you've got other traders that are out there anticipating what that doom loop could look like, I mean, I'm taking a look at short ratios right now, and the short to float ratio, and that's 21% for a company like PacWest Bancorp. I mean, you could go down the list and probably look at how that's moved even since March, but does that set up for some type of massive short to come in for these small or mid-sized banks? And then on the other side of that, does that then make the mid-sized banks or the small and regionals even more memey, as some of them had become, at a point coming out of March?
Yeah, that connection between meme call activity, the bet on sudden pop in those stocks versus the probably institutional speculative investors taking short positions. I think that's a relationship that's in place now. Will probably continue. I will point out too, to the options market, you can calculate probabilities of stocks falling really, well below a $5 threshold price, which tends to be where banks get in serious trouble and have to go to the FDIC. That probability is still up to about 15%. So there's pressure there, and I think that meme idea, you get certain days, like a day maybe like today, you see sudden major pops in these stocks, which is a bit deceiving in a sense, right? It doesn't really tell you about the health of the bank. It tells you more about real technical underlying factors that, on the one hand, people take a fundamental view on these banks saying, I'm going to short them or allocate away from them, against those who want to speculate in the options market.
Finally, I just want to take it back to the Treasury market for a second, because even with this loop happening, potentially putting a little more pressure on Treasury prices, isn't there a floor under Treasury prices? And where is that floor? Because there is sort of this intrinsic demand that's just going to be there for Treasuries, right? So I guess, where's the floor for prices, and conversely, the ceiling for yields in this particular cycle?
So if we believe the Fed's projections, and they are getting inflation really under control, and it slides down to the 2% target, the long-term interest rate for the Fed that they've estimated is 2.5%. That will be your floor, if you will, meaning 2.5% yield, higher price. I think that's where we're potentially going to head in the future, which means where we are currently at 4% in the 10-year or about, probably is going to be in some area there, a quote-unquote ceiling. Now, I'm a little cautious because the dynamics around the Treasury market are significant. Take the 10-year auction tomorrow. It's now more anticipated than ever before. We don't know how much bidding there will be from whomever comes in that auction. I think it underscores where we are currently. Right? We have a resilient economy, but we got a banking system that's sort of crunching and bleeding. And we got these different pressures on the Treasury market. Besides that, we have to digest all this additional supply from the Treasury that was announced last week, that may, by the way, continue in the following quarters. And as another factor, that the floor is you can quantify the floor from the Fed's forecast, but the ceiling on rates is, I think, a little gray area. So I take the view of that we'll probably test the upper end of the range, which is 4.3 initially, and then see where the demand really comes in there. And that's to be seen tomorrow.
Interesting. All right, we'll be watching that Treasury auction then. Ben Emons, good to see you. Thanks for coming in. Head of Fixed Income and Macro and Senior Portfolio Manager at NewEdge Wealth. Thank you.